Welcome to Age, Pension, Super and Retirement. I'm your host Yvonne, and as always, this is information only and not personal advice. In today's episode, we are going to look at transition to retirement and account-based pension, the start of the exit ramp. And to do so, I would like to welcome back the Director of Prosperity Planning Partners, Gayle McHugh.
Good morning. It's lovely to be with you again.
It is lovely, and I have to share with the listeners that the start of the exit ramp actually came from Gayle, who was looking for the start of the exit ramp when I called her last week. And so we thought it was the perfect part to this title.
Yes, I remember that traffic jam on the M1. Gotta love them.
Gotta love them. So, Gayle, just to recap briefly, what is the transition to retirement?
It's a special account that allows you to start to draw down on your superannuation to help you adjust either financially because you've dropped back from, say, 5 days a week to 4 days a week, or from 4 days a week to 3 days a week, that you're not out of pocket. But it doesn't mean that you have full access to your superannuation balance. You can take up to 10% of your account balance. And there's a big but here. You can't take any more while it's a transition to retirement pension. And the capital that you use to create your transition to retirement pension, which is also sometimes referred to as a transition to retirement income stream. So you'll also hear it called a TRIS. Okay, so a TTR or a TRIS, the account balance, the capital that you use to create that stays in accumulation phase. So you're still going to be taxed 15% on earnings, but the income that comes from that account, that TTR or TRIS account, effectively is tax-free in the hands of the recipient if they are over 60.
Okay, that's really helpful, Gayle. Thank you. When can a transition to retirement or TRIS be not just about the finances?
So it can help people to come to terms with the fact that they are moving from full-time employment or for like permanent part-time and reducing down to less hours in the workplace. And I had to be very careful about that because when I say the workplace can be your own home office these days. It doesn't have to be that you physically go to the office, but you're engaged in work activities. And the idea behind it is to basically say, we're going to start to explore what I might feel like if I'm not holding down my usual employment status. To be honest, that much of what we find as financial planners is that people have an emotional connection to their occupation or their title because that's who they identify as. So that this is a great opportunity for people to start to identify as not simply their occupation.
Fantastic. So this, in a way, gives them a bit of time to start exploring other options.
Exactly.
Right. Now, just to get clear on this, did you mention you need to be a certain age to start this TTR?
You have to have met your preservation age. So that's a key factor. But right now, everyone's preservation age is 60.
Perfect. And could you explain, is it taxed? And if so, how is it taxed?
The amount that comes out of it to the individual does not get taxed, but the account earnings do get taxed at 15%. It's not a true income stream in the form of an account-based pension that has very different tax treatments.
Interesting, Gayle. So now, can it be taken as a lump sum?
You can decide how frequently you want to have your payment frequency. So you can have it fortnightly, monthly, quarterly, half yearly, or annually. So yes, it can be taken as a lump sum, as a one-off payment in that year, up to that 10% balance that is the cap. When I say 10% balance, that's 10% of your balance as at the 1st of July each year. They recalculate whatever your balance was as at the 30th of June. the previous year, so the day before, they effectively use that to work out your account-based pension maximum payment. So let's say you had $200,000 in your, sorry, not account-based pension. This applies to account-based pensions too, but we're talking TTR specifically here. So if you had $200,000 in your TTR, you would be expected to draw down no more than 10% of that $200,000, so no more than $20,000.
And
that's the maximum.
That's the maximum. So is there a minimum if you start?
Yeah, it's 4% at the moment if you're between 60 and 65.
So this is what people do if they're still working, as opposed to if they've reached a condition of release or met a condition of release once they've turned 60.
Correct. And now the other trick with this TTR thing is that you can actually manage your budget effectively, look at what you need to spend, and you basically go, well, I want this much money to come out. I need this much money to live on. Let's say it's $60,000. You can look at whether you can bump up your superannuation contributions by salary sacrifice, or whether you take the lump sum and spend it on a holiday, or whether you buy a new car, improve your home, whatever. It's all up to you as to how you spend the proceeds of your TTR. But a lot of people use a TTR as a great trigger to help manage their ongoing personal tax situation.
Can you say just a bit more about that statement?
Is that not every employer has to agree to provide salary sacrifice opportunities. You have to have already spoken to your employer and had them agreed, and create not a retrospective, but a future moving agreement to contribute money to superannuation from your salary. It reduces your taxable income, and instead of paying tax at your personal marginal tax rate, it allows people to potentially get money into superannuation at 15%. This is allowing for the contribution caps, by the way, that apply, and that they are indexing again on the 30th of June 2026. So it does have some limitations, but I do know some people who are effectively salary sacrificing to super, and their tax savings contribute significantly to the amount that they're putting to super, and they're not that far out of pocket.
So helpful, Gayle. Thank you. So if someone's 65, can those people do what they want with their super?
Well, 65 is one of those magical mystery tour type date. It allows you to do pretty much whatever you want with your super. You can continue to be working. You can take it out, create an account-based pension, do ad hoc withdrawals as you need it. You can do pretty much whatever you want, because 65 is, if you were playing cards, that's the trump card for making any decisions around your superannuation.
I love that. So we can take out however much we want. Could you perhaps go through the different ways someone could take their account-based pension, as in time intervals or what have you?
Well, again, depending upon when you start your account-based pension in a given year, of course, 99.99% of the time, they never start on the 1st of July. I've never started one on the 1st of July in 28 years of financial planning. So what happens is the amount is recalculated as at the balance that you start with. And if you start, say, halfway through the year, you don't have to take the whole, if you're under 65, 4%, you can take 4% for half of the year. So effectively, we had $500,000 in super, and we chose to make that an account-based pension. At 4%, we would be required to take $20,000 out over the full year, that to meet the minimum payment. Now, with account-based pensions, you can take anything from the minimum payment right up to the full balance. So you can take anything from 4% up to 100% if you are under 65. Why you would is beyond me, but it's legally and technically possible.
100% over
of your account balance.
Once you're over 65.
Or you've met a condition of release and you've stopped work, and you after 60 and you've created an account-based pension, you don't have any maximums anymore.
Wonderful. And Can that account-based pension be taken out fortnightly, monthly, quarterly, yearly?
It depends on the provider. Some companies or superannuation providers do provide for fortnightly payments. Others say monthly is all we're going to offer you, as the minimum. It might be monthly, quarterly, half yearly, annually, but you've got to take the minimum payment to keep the account-based pension compliant. So if you take less than the full minimum that is required for that financial year, you actually are not meeting the requirements, and then you fall back into being taxed.
Okay, so what safeguards are there when people start this?
Most industry super funds, retail super funds, they have that built in. It's going to happen anyway. The reason I brought this up is that there are people who have account-based pensions who are in a self-managed super fund, and it's up to them to make sure that they take exactly the minimum or more to make sure that they don't flip that account-based pension back into accumulation phase.
That's really helpful, Gayle. Gayle, I'm curious, can you keep money in accumulation phase after age 65? And if so, why would someone do so?
You can keep superannuation in accumulation phase until the day you die at whatever, 100 if you want to. Some people just go, look, I've got so much money and I'm paying so much tax out here, it doesn't matter. Others people go, well, that's for a particular person. They try and earmark it from an estate planning perspective, which is not always helpful, but you can. The trick behind this is that you are still going to be paying 15% tax on the earnings. And if there's a capital gain in there and you sell and some assets are sold, your capital gains tax rate on assets that are held for more than 12 months in super right now, as at April 2026, is going to be 10%. So you're going to be paying tax in some way, shape or form that you don't necessarily need to. Some people will keep it in super up to pension age, eligibility age, I should say, which is another 2 years past the turning 65. And that's to shelter that amount from Centrelink asset testing and deeming.
That's really helpful. So some people have good reason to. Some people may just not realise and keep it there accidentally, would you say?
Well, you will laugh. I met with a retired accountant just recently and he's like, yes, our super fund doesn't pay any tax. And I looked at the income tax return for the self-managed super fund and it paid tax because it had a tax liability. He got a tax refund of the excess imputation credits and he was like, no, I haven't paid tax on this in years. And I went, let's look at the tax return. And when we looked at it, they had paid tax unnecessarily because they still had 2 accounts in accumulation phase. Oh, I had no idea. And if it can happen to a retired accountant, who else can it happen to?
Exactly. That's really scary, Gayle. So just to be clear, if someone met a condition of release at age 60 and then for sheltering purposes with Centrelink went from being in pension phase, can they then switch it back into accumulation till they're age 67?
Correct. They can do exactly that.
Is it a matter of just the name changes or does the money move?
Depends on your provider. Some providers will physically tell you that you've got to sell it down and move it back into a different account. That's the old-fashioned way of doing it. Most of them now have the capacity to do a transactional change at their level, at the provider level, and change it from being a payment and account-based pension to a accumulation account. It's going to have potentially, depending upon the provider, it could have a different account number. I know some of the providers I use, we can do pension resets on those by rolling it back to accumulation account, adding more money to it, and then rolling it back into pension phase, and it stays with exactly the same account number.
Okay. Now, you mentioned before salary sacrificing when working. Also, can you do this whilst receiving an account-based pension? And if so, how does this work tax-wise?
Well, salary sacrifice can not be added to an account-based pension because when you start an account-based pension, you start it with X number of dollars. and that's your balance for that everything is calculated on. Because there are components inside of superannuation. I see it in the group all the time. I don't want my kids to have to pay extra tax when I die. So people try and do a cash out and recontribution strategy to minimise the tax payable to non-financial beneficiaries under the SIS Act. And what that tends to do is when you start your account-based pension, if you've got 95% taxable and 5% tax-free, then that tax component is locked in for the whole life of your account-based pension. But if you went the other way and you said, I've got 95% tax-free and 5% taxable, that 5% that's taxable is going to be the part that your non-financial SIS beneficiaries would be paying tax on.
Fantastic. So someone's got their account-based pension and then they've still got an accumulation account to put money back into. Could you just mention how salary sacrifice works? And
So salary sacrifice is basically having an agreement with your employer. And a lot of healthcare workers, so nurses, teachers, those types of public service occupations have capacity to salary package. So they can do cars, meals, mortgage repayments, superannuation, depending upon their employer, they have different caps. So these people can do it by right as part of their employment agreement. But if you aren't one of these people, you can still ask your employer whether they are willing to allow you to do a salary sacrifice to superannuation. I did it years ago. I went to my employer and I said, hey, can we do this? He said, Gayle, we don't offer it, but if you can speak to the bookkeeper and make it happen, and it's not going to cost us a lot in time or effort, happy to support you and let's do it. I was managing the place at the time, so I then got that approved for me, which meant that he then had to offer it to every other person in the building who was employed. It's about knowing the system and knowing that you can ask. The employer does have the right to say no if they consider it's going to be onerous, but you have to pre-organise it, have to put it in writing. You have to tell them exactly how much you may wish to salary sacrifice to superannuation, and then they control the payments to your super fund. So from the 1st of July 2026, everyone is going to have to do payday super. So it means that instead of having the money sit with your employer for potentially months now, because the current rules say you've got to have your employee payments to super made by 28 days after the end of the quarter. So after the end of March, June, September and December, currently the system says if you're an employer, you've got to have paid your super by the 28th. From the 1st of July, it's going to be an entirely different story where you've got to pay your super every time you pay your employees.
Wow, that's so helpful, Gayle. So just to be clear, if someone's met a condition of release and they've got their account-based pension and they're still working and their employer agrees, they can do salary sacrifice, and it would probably seem seamless in a way to them because of their age, they're not having to wait. A lot of people don't want to do salary sacrifice when they feel that it's locked away.
Well, true, but I've got people who are under 40 doing salary sacrifice because they looked at their tax position, and this particular person had been living out of the country for some time, and they went, oh, my super's pretty low, I should probably build this up a bit. So they decided to do a salary sacrifice. They were putting $200 a week to super and coping quite well financially. And then they got a pay rise of, I believe it was $6,000 for the year. And then they went, well, what's my tax position going to be? So they were going to be actually worse off if they took the $6,000 as cash over the year. And we worked out that if they put an extra $100 in this particular person's instance into super, so instead of putting $200 a week, they were putting $300 a week into super, they were out of pocket $6.
Wow, the maths is interesting and the time for compounding is fantastic.
And he went, Mum, that's not even a beer. So that was one of my boys who's doing that.
That's fantastic. Not even a beer. I love that. Gayle, how can you be reached?
You can contact me by email, Gayle, Gayle, at prosperityplanning.com.au, or you can call me on 0407 159 298.
Wonderful. And just a quick one, I think you kind of answered it, but just to be clear, if someone's on a transition to retirement account, do they need to do anything to actually change it to an account-based pension at age 65?
No, it basically automatically changes as soon as you hit that magic 65 date. You can do pretty much what you like.
That's wonderful. For all our international listeners wishing to join our Facebook group, the code word is yellow. And as always, this is information only and not personal advice. Thank you so much, Gayle.
You're welcome.